Hello, this is Jordan. This video is being recorded on the late evening of Sunday, September 25th, 2022. You'll probably be watching this on Monday, but thank you so much for joining me. And in this video, I'm going to provide a short-term technical outlook for the stock market and also discuss another major sell signal. But of course, if I put crash here in the picture in the title, that's some healthy clickbait that will attract more views. So you can mind that as we get into the video analysis. Now, here's the first thing I want to look at. And with respect to the stock market and secular bears, I've been talking a lot about the 40-month moving average and how important it is. And we know that the market is, there's an extreme risk that it's going to close below that moving average at the end of the month, at the end of this week. So that's obviously going to be a major sell signal. But here's another important thing to look at, and that's the 20-month moving average, which is also the 400-day, or I believe the 82-week moving average. So all those are similar. So here on the weekly line chart, I'm using the 82-week moving average. Again, this is equivalent to the 400-day or the 20-month. And this is just something, even 15 years ago or 10, 12 years ago, when I was just playing around with a lot of moving averages, I noticed that the 400-day to me was a lot more significant than the 200-day. Now, I don't want to do a little bit of a humble brag here, but I have to anyway. I did, for the International Masters Program for Technical Analysis, the MFTA, you have to do a paper. And so I did a paper analyzing the 200 versus the 400-day moving average as far as which is a better sell signal, which is more effective, which has more whipsaws and that sort of thing. And the 400-day came out as a much better sell signal, basically. Now, obviously, the market already broke that, but I'm just illustrating the importance of the 400-day. And you can see here, I'm pointing out, or I'm putting an arrow each time the market broke below the 400-day, which is also the 20-month moving average, but then rallied back up to it and failed. So all of these arrows show when the S&P 500, it had broken below that moving average, but then rallied back up to it and then failed. And so we can see here the only time this wasn't a really significant sell signal was after the stock market crash in 1987. Going into 1988 when it bounced back, you can see it fell below that moving average. It rallied back up to it. Then it failed, and you can see it failed a couple times, but eventually it punched through. So no indicator is completely foolproof. Nothing is perfect, but this, rallying up to that moving average and failing. And by the way, not only did the market rally up and fail at the 400-day, it also rallied and failed at the 200-day. That could be another video. I could have put that in here, but it'd be more difficult to view. So that makes it even more significant. But we can see here, it happened in the 60s. And even in 1977 and 1982, even the failure in 81 or 82, whenever that happened, even at that failure, the market dropped 20% after, when it got right up to the moving average. And I think in 77, it was 13% or so. So, and you can see the same thing happened in 1966. You'd have to zoom in there. It broke below it. It hung up at the moving average, and then it really fell. But, the best comparisons are obviously there in the boxes, when you're starting or you're in a secular bear market. And so we can see in the 1968 to 1970 period, clearly the market, it fell below it, and then it rallied back up to it and failed. Then you had the big decline. Same thing happened in the 73 to 74 period, pretty significantly. And also in 2008, that's really obvious there what happened. Now, the 2000 to 2002 bear, it didn't really, I probably shouldn't have marked that. Maybe might be better evidence of that on a bar chart. But anyway, enough with me talking. You get the point. This is a really significant sell signal. And so this is pretty precarious where the market is at. I don't like to use the crash word. I only like to use that in titles for clickbait. But there's risk of a big dump lower here, and getting into. I mean, I spent too much time on that moving average, but I'm sorry, I did my master's thesis on it, so I could talk all day about it. So here we have the S&P 500. Okay, daily chart. We have the 400-day moving average. You can see the two arrows there. At the top right, those are the next two really significant support levels. You have about 3,500 and then around 3,250. Now, those are also Fibonacci levels. So you can see they're key levels if we're just looking at the price the price action in the chart there. But in addition to that, they're Fibonacci levels. One thing I also want to mention, the 80-month moving average, which I don't think I've ever talked about, but that can be significant. That's coming in the 3,100s. So around 3,200, you have a confluence of strong support in that area. So if there's any accelerated decline coming around 3,250, 3,200, that's the place where you're likely to see another decent bear market rally. So that's, again, if we're getting a crash in the next 2 or 3 weeks, that's probably where it's going to go. The other scenario is you can see the market come down to 3,500, that Fibonacci level, and then you get a bounce there, but it's probably a weak bounce. And then after that, you get a decline to around 3,250. Now, if we're looking at, there's tons of indicators you can look at. We can look at the VIX, the put call, and then also the two breadth indicators at the bottom, new highs minus new lows, percentage above the 200-day moving average. If you look at those, I marked 2020 and 2008 because those are the two most significant extremes we've had in the last 15 years. And, we don't necessarily have to go all the way down to those levels to get a good bear market rally, but there's good context. And if we're looking at new highs minus new lows and the percentage above the 200-day moving average, which is 15%, they're pretty oversold. But if we're getting into the point where the market, there's really risk of an accelerated decline or a mini crash here, there's a lot more room for those indicators to come down. In that scenario, percentage of the 200-day, that could come down to 5% or 7% before you get a sustained bear market rally. And also look at the put call ratio, which I smoothed with the 10-day moving average. You can see that in blue, and the horizontal line there shows where it peaked late 2008, 2020. And the other peaks were around, they were below 1. The current 10-day moving average is at 0.74, but that's not anywhere close to 1. It's not even close to 0.9. So, and the same thing with the VIX. If we're looking at the VIX, I drew the line well below those peaks in 2020 and 2008. I drew the line close to 50. The VIX is at 30. I don't know what's going on there, if someone's suppressing it, if there's some intervention there to stop it from spiking. But again, that's another indicator that's not even close to an extreme level. Now, obviously, these things can change. If you get a hard dump lower where the market drops 5 or 7% this week, then you could, you could see all these things spike. And so, as far as when, to conclude, as far as when this will end, again, it's a combination of looking at the indicators, seeing real extremes there, and then combined with looking at support levels, be it 3,500 or 3,250. So 3,250 is what is that? That's a little more than 11% or so. I don't want to waste your time trying to calculate it, but yes, if we get some kind of mini crash, these indicators will spike, and you can see the S&P come down to 3,250. That would be my conclusion. Other scenario is you come down to 3,500, you get a weak rally from there for a little while, then you get another dump. So either or is a possibility. Didn't talk about gold in this video. I will in another time this week. You can check the video I did on Friday. Thanks so much for tuning in, everybody, and I'll talk to you again soon.